So the stock market has had one of its best first halves of the year in a long time, but there are still bargains to be found, I believe. So one that I'm watching, and then Tyler's going to give you one that I'm really interested to hear about. One that I'm watching closely right now is EPR Properties, a company that I've talked about a lot on these videos. The biggest overhang over the stock is the Regal bankruptcy. Its number three tenant is Regal Entertainment, the movie theater operator, and they've been going through bankruptcy proceedings for the past year or so. And they just announced a resolution to it. Now, whether it's a good deal or not for EPR depends on your thoughts on the movie theater industry in general. So, yeah, Regal rents 57 of its theaters from EPR today. They're keeping 41 of those under the bankruptcy agreement. The 11 of the other ones are being sold by EPR and 5 are being taken over by other operators. The other 41 are being placed in a new master lease that has two components, and this is where it gets interesting. There's a base rent amount that it replaces about 80% of what EPR was making from Regal before the bankruptcy. So about 80% is covered by base rent. The rest of it, if Regal's based on Regal's 2022 sales, box office revenue, if Regal beats its 2022 box office revenue in any given year, it has to give a percentage of that revenue to EPR in addition to its base rent. So it's like a performance-based lease. This isn't uncommon. A lot of restaurant leases have that kind of structure built in there. If the restaurant performs well, they have to pay a little more rent. So not an uncommon thing, but the movie theater business has a lot of big question marks. People are still going to be going out to eat in 5 years. Are they still going to be watching movies in theaters as much as they are? That we don't know. So if the current box office projections by the experts in the industry are correct, this should in all replace about 96% of EPR's pre-bankruptcy rent from Regal from only 41 properties, not 57. And that gives them 11 extra properties to sell and make a little bit more money off of, which it could invest in, diversify away from theaters, which is another big priority of the companies. So if the theater business does well, this could be a great deal for EPR. There's the potential they can make more than 100% of what they were making from Regal before bankruptcy if theaters are doing well. So I don't know. It's more of a gamble than the old lease structure, if you will. But it's a resolution is great. Markets hate uncertainty, and I like it. I like the deal. I like that they're going to have some properties to sell and free up some capital. Because I think that was one of your biggest concerns about EPR, Tyler, is how do you grow from here without and just avoid becoming essentially a bond?
Yeah, I remember we discussed that a while ago where there was ambitions to be very growth centric, but their balance sheet kind of told them otherwise. But yeah, so you
Nice.
asked me to come up with an idea, and we're going to get a little weird here because sometimes I get a little weird. And I'm looking at One Liberty Properties. It's a $420 million real estate investment trust. And what is intriguing to me about this particular company is it's a bit of a misunderstood turnaround company. For the longest time, it had this random smattering of net leases all over the place. Its largest tenants were LA Fitness and Haverty Furniture. So not exactly the most inspiring thing. But over the past like 6, 7 years, they've made a very concentrated effort to sell down a lot of like retail and office and focus really, really hard on industrial real estate, warehouses specifically. And now, as of the most recent quarter, about somewhere between 60 and 65% of their annualized base rent is now exclusively coming from industrial real estate, which is one of the best markets to be in right now. So you have this, industrial real estate business kind of masquerading as something else. And the stock is incredibly cheap. Right now, it has a dividend yield of about 9%. Granted, it hasn't grown much over the years as it's been turning over that portfolio, and it's got a little bit more debt than some people would be comfortable with. But because of that turnaround into a faster growth market in industrial real estate with that high yield, and also about 22% of the stock is actually owned by either directors or insiders. Most specifically, Gould family, who are the founders of the business. And so, when you see that much interest from a single entity, a lot of that family's wealth is tied up into this particular company. And so they're probably less likely to do something that's going to either impact the dividend statement or, kind of derail this company financially. And so you kind of toss all that together, and it may not look like the safest bet right now, but considering high interest rates and the other options available in the real estate market, this actually looks pretty discounted relative to everything else. And I think something that people may want to sniff at if they're looking for high yield in something in the real estate market.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.